CFA Level 1 Practice Questions. Learning Module, Working Capital and Liquidity. Topic, Cash Conversion Cycle. All else equal, an issuer that successfully negotiates longer payment periods with its suppliers will most likely experience A lengthened cash conversion cycle. B. Shortened cash conversion cycle. C. Decline in its quick ratio. Which of the following management actions will most likely shorten a company's cash conversion cycle? A. Offering more lenient payment terms to its customers. B. Increasing its investment in safety stock inventory. C. Taking full advantage of supplier credit by paying on the net day. An analyst gathers the following activity ratios for 3 issuers. Issuer 1, days of inventory on hand 10, days sales outstanding 20, days payable outstanding 35. Issuer 2, days of inventory on hand 25, days sales outstanding 15, days payable outstanding 25. Issuer 3, days of inventory on hand 30, days sales outstanding 25, days payable outstanding 15. Which issuer has the shortest cash conversion cycle? A. Issuer 1, B. Issuer 2, C. Issuer 3. An issuer decides to take advantage of its full trade credit period by paying suppliers on day 45 instead of day 30. Assuming no other changes, the effect on its cash conversion cycle is A lengthening, B. Shortening, C. Neutral effect. An issuer is comparing a bank loan at an effective annual rate of 12% with the cost of foregoing a supplier's discount with terms of 210 net 30. The best decision in terms of the lower cost of financing is to forego the discount and use the supplier's financing to pay on day 30. B. Borrow from the bank to take advantage of the trade credit terms. C. Use either option because the cost of the bank loan and the cost of the trade credit are identical. An issuer needs to choose the most expensive source of supplier financing from the following credit terms if discounts are foregone. A. 110 net 30. B. 210 net 30. C. 310 net 30. Which set of terms has the highest effective annual rate? A. Option A. B. Option B. C. Option C. Which of the following events will most likely shorten a company's cash conversion cycle? Customers taking longer to pay their invoices. B. A key supplier requiring payment within 15 days instead of 30 days. C. The successful launch of a new product that sells rapidly. Days payable outstanding, DPO, is subtracted in the cash conversion cycle, CCC formula. Therefore, increasing DPO through longer payment periods mathematically shortens the total cycle. Negotiating longer terms allows the issuer to retain cash longer, effectively using vendor financing to improve working capital efficiency. Lengthening a payment period is an increase in DPO, not a lengthening of the cycle itself. A longer DPO means the issuer waits longer to pay, which is a shortening of the time cash is tied up. While longer payment periods increase accounts payable, a current liability, the focus remains on the CCC. A decline in the quick ratio is not most likely because the retention of cash can offset the increase in liabilities. Days payable outstanding, DPO, is a subtracted variable in the CCC equation. Paying on the net day rather than early increases DPO, which mathematically shortens the conversion cycle and allows the firm to retain cash longer. Lenient terms lead to customers paying slower, which increases days sales outstanding, DSO. Since DSO is added to the cycle, it lengthens the CCC. Similarly, increasing safety stock increases days of inventory on hand. Because DOH is also an added component, it ties up cash longer and lengthens the cycle. A shorter CCC achieved by increasing DPO or decreasing DOH or DSO means an issuer converts inventory into cash more quickly. Maximizing supplier credit, high DPO, is a primary strategy to improve working capital because it leverages vendor financing to reduce the need for alternative funding. The shortest cycle is identified by applying the formula DOH plus DSO minus DPO. Issuer 1 is the shortest because its days payable outstanding, 35, is greater than the sum of its inventory and receivable days, 30, resulting in a negative CCC, minus 5. A negative CCC, like issuer 1's, is an ideal scenario indicating the issuer receives cash from customers before paying its suppliers, effectively using vendor financing to fund operations. This represents the most efficient liquidity position because it minimizes the need for external financing to support working capital. Days payable outstanding, DPO, is a subtracted component in the CCC formula. Mathematically, increasing the DPO from 30 to 45 days results in a reduction, shortening of the overall cash conversion cycle. Delaying payments allows an issuer to utilize free financing from suppliers, which effectively keeps cash in hand for a longer duration. Maximizing the trade credit period improves liquidity by reducing the time cash is tied up in the operating cycle, thereby decreasing the need for alternative external financing. The 20-day credit extension, 30 days to 10 days. Foregoing the discount means paying a 2% fee just to wait an extra 20 days, which creates a very high periodic interest rate of 2.04%. Massive gap between the 44.6% EAR for supplier financing and the 12% bank loan. By borrowing from the bank to take the discount, the issuer saves approximately 32.6% in effective annual interest. Borrowing from a third party at a lower rate to pay suppliers early is a standard strategy to avoid the high cost of supplier financing. The implicit interest rate of foregoing a short-term trade discount is nearly 4 times higher than the bank's 12% rate, making any choice other than the bank loan financially inefficient. Foregoing a discount allows the issuer to borrow funds for a specific credit period, net days minus discount days, which in all 3 cases is 20 days. Even a 1% discount results in a high 20.1% EAR. When the time frame, 20 days, is constant, the effective annual rate, EAR increases significantly as the discount percentage rises. Option C is the most expensive because a 3% discount for only 20 days of extra credit creates a massive implicit interest rate of 74.3%, making it the most costly source of financing among the choices. Rapid sales reduce days of inventory on hand, DOH. Because DOH is a primary component added in the CCC formula, any reduction in inventory duration mathematically shortens the total cycle. Option A. Customers taking longer to pay increases days sales outstanding, DSO. Since DSO is an added value in the formula, an increase results in a lengthened CCC. Option B. Paying suppliers faster in 15 days instead of 30 decreases days payable outstanding, DPO. Because DPO is a subtracted value in the equation, reducing it results in a longer cash conversion cycle. Topic: liquidity. An issuer changes its credit terms offered to customers from net 30 to 110, net 30. All else equal, the most likely effect of this new prompt payment discount is to A. Create a pull on liquidity. B. Create a drag on liquidity. C. Improve liquidity. An analyst calculates the following liquidity ratios for a manufacturing firm: a current ratio of 2.2 and a quick ratio of 0.8. The large difference between these two ratios is most likely due to a high level of accounts payable, B. Cash and equivalents, C. Inventory. An analyst is evaluating an issuer's liquidity and calculates a negative cash conversion cycle for the issuer in the most recent fiscal year. This result is A. Not feasible. B. Possible, because the issuer has sufficient cash and marketable securities on hand to support short-term needs. C. Possible, because the investment in inventory is returned quickly and the issuer takes advantage of vendor financing. If a company begins offering a new prompt payment discount to its customers, this action is most accurately described as a strategy to A. Lengthen its cash conversion cycle. B. Reduce a drag on its liquidity. C. Create a pull on its liquidity. A firm reports the following financial data as of December 31st in $ millions. Cash $150, marketable securities $50, accounts receivable $400, inventory $800, accounts payable $350, wages payable $100, and a long-term loan of which $250 is due within the year. The current ratio for the firm's industry is 2.1. Based on the current ratio, the firm's liquidity compared with the industry is best described as being A. Equivalent, B. Lower, C. Higher. Which of the following actions by a firm is most likely considered a secondary source of liquidity? A. Drawing down on an established bank line of credit. B. Renegotiating a debt contract to extend its maturity. C. Collecting cash from customers on accounts receivable. An analyst observes the following year-over-year changes in a company's activity ratios. Days of inventory on hand increased from 25 to 35 days. Days sales outstanding increased from 30 to 40 days. Days payable outstanding decreased from 40 to 30 days. The combined effect of these changes on the company's liquidity is most likely A. Significant improvement. B. Significant deterioration. C. Neutral impact. An analyst calculates the cash ratio for a company. A high cash ratio relative to its industry peers most likely indicates the company has a large amount of inventory. B. Is highly reliant on short-term debt. C. Has a strong ability to meet immediate obligations. The shift to 110, net 30 inches provides a financial incentive for customers to pay within 10 days rather than 30, which reduces days sales outstanding, DSO. By reducing DSO, the cash conversion cycle, CCC, decreases, allowing the issuer to convert receivables into cash faster and strengthening its ability to meet short-term obligations. A pull on liquidity involves accelerated cash outflows, like paying suppliers early, whereas this discount affects cash inflows. A drag on liquidity occurs when cash inflows lag, such as customers delaying payments. Because a prompt payment discount speeds up these receipts, it is the functional opposite of a drag and results in improved liquidity. Current ratio includes inventory in its numerator, whereas the quick ratio specifically excludes it to measure more immediate liquidity. Because both ratios share the same denominator, current liabilities. A significant gap between a 2.2 current ratio and a 0.8 quick ratio mathematically identifies inventory as the dominant component of the firm's short-term assets. Manufacturing firms typically require substantial inventory levels to support operations. Since inventory is less liquid than cash or receivables, its presence can create a high current ratio, while the firm remains less liquid according to more conservative measures, like the quick ratio. A negative cash conversion cycle, CCC, is a real-world scenario where a firm receives cash from customers before it has to pay its suppliers. This is achieved through a combination of rapid inventory turnover, low DOH, and maximizing vendor financing, high DPO. Slow cash inflows, high DSO, are classified as a drag on liquidity. By incentivizing customers to pay faster, the company reduces its days sales outstanding, DSO, which mathematically shortens the cash conversion cycle. Accelerating these inflows directly mitigates the liquidity shortfall caused by lagging collections. A pull on liquidity involves an acceleration of cash outflows, paying others faster. Since a discount speeds up inflows, receiving cash from customers, it cannot be a pull. It emphasizes that the strategy is the functional opposite of lengthening the cycle. It accelerates cash recovery, thereby enhancing the issuer's liquidity position, rather than straining it. Current ratio is the broadest measure of liquidity, meaning it includes all short-term assets, including less liquid ones like inventory. 150 plus 50 plus 400 plus 800 equals 1,400. Classifying the $250 million long-term loan due within the year as a current liability. Sources define current liabilities as those expected to settle within 12 months. The firm's calculated ratio, 2.0, is less than the industry average, 2.1. Its liquidity is mathematically lower. In this context, a higher ratio represents greater liquidity. Contingency measures used during crises when primary sources are insufficient. Renegotiating debt contracts, like extending maturity, is a secondary source because it signals financial stress and involves altering the firm's financial structure rather than generating immediate cash from operations. An established bank line of credit is a prearranged, committed facility. Because it is a readily accessible tool used in normal liquidity management, it is classified as a primary source, not an emergency measure. Collecting accounts receivable is a primary source because it is a routine, recurring part of the daily operating cycle. Unlike secondary sources which require active, non-routine restructuring decisions, collecting receivables is a passive result of standard business activities. All three changes, higher DOH, inventory, higher DSO, receivables, and lower DPO, payables, mathematically lengthen the cash conversion cycle. A longer cycle means cash is tied up longer in operations, which directly increases the firm's reliance on external financing and signals weaker liquidity. It is important to notice that these changes are not offsetting, because every variable moved in a direction that harms the cycle. The result is a significant deterioration, rather than a neutral impact. The company is experiencing a double hit. It is slowing down cash inflows via higher DOH and DSO, while simultaneously accelerating cash outflows via lower DPO, which represents a severe strain on available funds. Cash ratio measures a firm's ability to satisfy obligations without waiting to sell inventory or collect receivables. It is the most conservative liquidity measure because it only considers the most liquid assets, cash, and marketable securities. A high ratio relative to peers indicates superior short-term solvency and financial flexibility. Inventory is mathematically excluded from the numerator of the cash ratio, making its level irrelevant to this specific calculation. Since short-term debt is a current liability, the denominator, higher debt levels, would actually decrease the ratio. Thus, a high ratio suggests the firm is less reliant on short-term debt relative to its liquid assets. Topic: Managing working capital and liquidity. A firm that matches its long-term financing to its permanent current assets and uses short-term financing for its variable current assets is pursuing a conservative working capital approach, B, moderate working capital approach, C, aggressive working capital approach. Which of the following actions is a key feature of a conservative working capital management strategy? A, minimizing accounts receivable through strict collection policies. B, maintaining a large portfolio of marketable securities. C, relying heavily on supplier trade credit for financing. A company has accounts payable of $5 million with credit terms of 115, net 45. If the company chooses to forego the discount and pay on the net day, the immediate liquidation cost incurred is closest to A. $50,000, B. $350,000, C. $500,000. A company tightens its credit policy by changing the terms offered to customers from 210 net 45 to 210 net 30. The most likely effect of this change is A. An increase in accounts receivable, B. A decrease in accounts receivable, C. No change in accounts receivable. A company discovers that a significant portion of its finished goods inventory has become obsolete due to a shift in consumer preferences. The situation is best described as A. A pull on liquidity, B. A drag on liquidity, C. A secondary source of liquidity. A company needs to increase its cash balance and is considering two actions. Option 1. Factor its accounts receivable with a 4% fee. Option 2. Accelerate payments to all suppliers to take advantage of a 2% early payment discount. Which option successfully increases the company's immediate cash balance? A. Option 1. B. Option 2. C. Both Option 1 and Option 2. The moderate approach is fundamentally based on a matched approach, where the maturity of the financing is aligned with the maturity of the asset. It is the only approach that splits financing this way: long-term capital for stable, permanent assets, and short-term resources for seasonal, variable assets. A conservative approach is distinguished by using long-term financing for all current assets, including variable ones, which is more expensive but safer. An aggressive approach is distinguished by using short-term financing for all current assets, including permanent ones, which reduces costs but increases refinancing risk. Because the question specifies using long-term financing only for permanent assets, it mathematically excludes the other two categories. Conservative strategy is maintaining a large cushion of liquid assets, specifically cash and marketable securities, to ensure immediate access to funds. This approach prioritizes risk reduction and safety over profitability, using long-term financing to cover most current assets to avoid the rollover risk of short-term debt. Minimizing accounts receivable, Option A, is an aggressive tactic. A conservative strategy involves holding more receivables and inventory relative to sales than an aggressive one, providing greater flexibility during market disruptions. Relying on trade credit, Option C, is a short-term, aggressive tactic that increases current liabilities and liquidity risk. A conservative strategy avoids this reliance because it increases a firm's vulnerability to supply chain disruptions or sudden changes in supplier terms. Liquidation cost refers to the immediate dollar value of the forfeited discount, rather than an annualized interest rate, EAR. Mathematically, the cost is determined by simply multiplying the accounts payable balance by the discount rate, 5 million times 0.01. Using effective annual rates to determine liquidation cost is incorrect. The goal is to find the direct cash loss resulting from not paying within the discount period. This cost represents the price the company pays to use the supplier's funds for the remainder of the net period, in this case, an additional 30 days. The shift from net 45 to net 30 shortens the full payment period by 15 days, giving customers less time to pay. This reduction in the allowed payment timeframe mathematically reduces the average collection period, DSO, as it encourages faster settlement of accounts. Because customers are required to pay sooner, the total accounts receivable balance decreases, while extending a net period. For example, from 30 to 40 days increases receivables and creates a drag on liquidity. This tightening action accelerates cash inflows and reduces the company's investment in working capital. A drag on liquidity specifically involves factors that reduce or delay cash inflows. Obsolete inventory is a primary example of a drag, because it becomes challenging to sell, causing inventory levels to rise and tying up cash that cannot be easily converted back into a liquid form. A pull on liquidity is defined by an acceleration of cash outflows, such as paying suppliers early. Since obsolete inventory affects the receipt of cash rather than its expenditure, it cannot be classified as a pull. Secondary sources of liquidity are strategic, non-routine measures used in crises, such as selling off subsidiaries or issuing equity. Obsolete inventory represents a failure of a primary operating asset and provides no reliable backup value, often requiring further cash to dispose of, write off. Factoring converts a non-cash asset, receivables, into immediate cash, providing an upfront inflow. While there is a fee, the primary result is a net increase in the cash balance, which directly addresses the company's need for liquidity. Accelerating payments to suppliers is defined in the sources as a pull on liquidity because it involves an acceleration of cash outflows. While a 2% discount is a cost-saving measure, it reduces the immediate cash balance because the firm forgoes the use of those funds sooner than necessary. Factoring provides a cash inflow, whereas accelerating payments creates an immediate cash drain, making option 1 the only choice that successfully increases the current cash balance.